If you want to make money in the stock market, then stop this insane behavior. Let's talk about it. Here's the problem. I don't have a clue why the market sold off like they did on Thursday. Maybe it was the employment numbers. I don't know, but does this make any sense? And by the way, it's interesting to compare ChatGPT when you ask it why the market sold off. It says maybe there were some U.S. economic concerns, Japanese policy changes, Japan raised their interest rates. What's interesting is this is totally incorrect. In response to these events, investors fled to safer assets like U.S. Treasuries. No, they didn't. They ran away from U.S. Treasuries, as you can see here. They sold them off. So ChatGPT, Now let's take a look at what Grok said. Well, Grok said, Federal Reserve's actions and statements. Yeah, that could have come into play. Economic data, possibly. Bond market dynamics. That makes some sense that people felt that it overshot. Recession concerns easing. That should be a positive. Market sentiment and positioning. Other tech sector influence. So this seems a little bit more reasonable. And when you combine it with the first two from ChatGPT, number 3 was totally wrong. So going back to what I said, does this make any sense? Really? I mean it. Do you think these geniuses who sold on Thursday were smart enough to get back in by the end of the trading session on Thursday when the market was down 1.3%? The obvious answer is no. Look, over the short term, the stock market is a voting machine, as you can see here. But over the long term, the stock market is a weighing machine. What do I mean by this? Well, in the short term, the stock market moves according to the dollar volume of buy orders versus the dollar volume of sell orders. If there's a larger dollar volume of buy orders than sell orders, the markets or an individual stock will go up. But if there's a larger dollar volume of sell orders than buy orders, the opposite will happen, as you can see here. But over the long term, the price of the major indices and the individual stocks in them will be related to the growth and the quality of their earnings and financial statements. This idea that investors need to do something in reaction to a single news event is nuts. It's absolute insanity, so don't do it. Look, there are many facets and events that drive the economy and the earnings of publicly traded companies, so reacting to a single news event or economic report is insane. Even back in 2020, when COVID became obvious, would you have been smart enough to sell your stocks here or here before they dropped 35% or more, and then be smart enough to buy them back here in late March near the bottom? No, you wouldn't, so don't even try it. Look, if you want to make good returns as an investor in the stock market, then don't listen to CNBC, Bloomberg, Reuters, or any of the other financial news networks, and certainly don't go and sell everything, ever. But it's much worse than just this past week. This insanity wasn't confined to just this past Thursday. Look at the S&P 500 over the past 20 days. It happened here, 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 and here, where this most recent drop was on Thursday. If you reacted to any of these moves, you most certainly wouldn't have sold at the peak. No, in the best case, you would have sold partway down, or worse yet, more likely near or at the bottom. But wait, there's more to the damage caused by this insanity. When would you have gotten back in? Would you have been genius enough to buy back in down here near the bottom? The answer is a resounding no. So don't try to get cute and sell your equity holdings just because the market is dropping or some news event scares you. Why do I keep pounding the table about dollar cost averaging? Well, because if you keep buying during regular intervals, your returns over the long term, and I mean 5 to 20 years, will most likely be triple your returns if you try to time the markets. Hey, I'm not kidding. Just look at the returns of the average investor versus the S&P 500 over the long term. You can see here the average investor has severely underperformed the S&P over the long term. I mean, over 20 years to get a 5% return when just by staying put, you could have had almost a 10% return. That's insanity. But the real killer here is look at the average bond investor returns. Now, I guess I shouldn't be surprised by this. Bond investors are inherently afraid and risk averse. So when they see risk in the bond markets, it looks like they turn tail and run. And then they don't get back in before the bonds go up. So they also severely lagged the aggregate bond index. And by the way, these returns are nothing to write home about. And certainly these are awful. You're not even keeping up with inflation here. Oh, and by the way, this is a topic for another video, but it might also make sense to dollar cost average out of your investments when you need to raise cash to cover your living expenses during retirement. Now there's a thought. What do you think of this craziness in the markets lately? Did you sell during any of these recent downward moves? Or did you dollar cost average in and buy more? Please let me know in the comments below. As you can see from the price movements and metrics in the buying and selling pressure charts for equities, the equity markets are trying to recover and move higher after the recent pullback, with the ARK Invest's ARKK Innovation Fund and small caps leading the way, and treasuries have been rallying nicely from their recent pullback. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.